By the time you finish your morning coffee on the day you turn 71, the government has already decided how much of your life's work they are going to take, and if you haven't signed a single piece of paper, that amount is likely 50%. This is not a warning I give lightly. This is the moment your RRSP stops being your money and starts being the government's income stream, and they don't ask permission. They just start taking. Now, you might be thinking, I have a financial advisor. They would have told me about this. Here's what I need you to understand. Most professionals focus on one thing and one thing only. They focus on building your account. They focus on accumulation. They run projections about how much you can save, and they congratulate you when the number gets bigger. But nobody is watching the exit door. Nobody is standing at the end of your driveway with a mirror showing you what the government sees when they look at your balance. That is a completely different job, and it requires a completely different expert. That is what I do. I am not here to grow your wealth. I am here to protect what you already have. And what I am about to show you could be the most important thing you learn this year. The first thing you need to understand is that your RRSP is not entirely yours. I know that sounds strange because you earned every dollar in that account. You deferred every dollar of tax to put it there. But here is the dirty little secret that nobody at the bank will volunteer to tell you. The CRA, which is our tax department, they own a piece of your RRSP. They own the piece that represents the taxes you never paid. You get to invest it, you get to watch it grow. But the moment you turn 71, the government gets to treat every single dollar in that account as income, and income gets taxed. Let me paint this picture for you so it becomes real. Say you have $200,000 sitting in your RRSP when you turn 71. That $200,000 is going to get converted into something called a RRIF, which is a registered retirement income fund, and the government is going to force you to take out a minimum amount every single year. That minimum amount is not a suggestion. It is the law. And here is where it gets painful. Because every dollar that comes out of that account gets added on top of every other dollar of income you already have. If you are already collecting CPP, if you are already collecting old age security, if your spouse has their own pension, all of that income stacks. And the moment your total income crosses a certain threshold, the government starts taking back your OAS benefits. They call it a clawback. I call it the government takeback, and it can cost you thousands of dollars every single year. If you want to stop being a passive observer of your own tax bill, hit the subscribe button so we can keep building your shield together. Once that is done, the next move is to understand the second death trap, and this is where most people have no idea what is coming. When the first spouse dies, something very dangerous happens to the survivor's tax situation. The survivor inherits the deceased spouse's RRIF, and that inheritance sounds like a gift. It feels like a gift. But here is what it actually is. It is income. The entire balance of that RRIF gets added to the surviving spouse's income in the year of death, and that can push them into a completely different tax step. I want you to hear that clearly. In the year your spouse dies, the government can put you in a tax bracket that takes a massive chunk of the estate you spent your whole life building. This is what they call a estate meltdown, and I have seen it destroy retirement plans overnight. But there is a protection that most people never hear about. It is called a survivor benefit, and it allows the younger spouse to transfer the deceased spouse's RRIF directly into their own RRIF without triggering a tax bomb. This is not automatic. You have to do paperwork. You have to elect it. But if you do not elect it, the government assumes you want the full balance taxed as income, and they will not ask you twice. So please hear me when I say this. If you are over 60 and you have not talked to your accountant about the survivor benefit election, that conversation needs to happen this week. Now let us talk about the TFSA, because this is where a lot of people are leaving money on the table without even knowing it. Your TFSA, which is your tax-free savings account, is one of the most powerful tools in your entire financial picture, and here is why. When money sits inside your TFSA, it grows completely tax-free, and when you take it out, it comes out completely tax-free. No matter how much you have in there, no matter how much it grows, the government never gets a piece of it. That is unlike your RRSP, where every dollar you take out is taxable income. Now, here is the connection that most people miss. Remember how I told you that your OAS can get taken back based on your total income? Your TFSA income does not count toward that total. It is completely invisible to the government when they are calculating your OAS recovery tax. This means if you have money sitting in your TFSA, you can draw from it strategically to fill in the gaps between your other income sources, and it will not trigger a government takeback. You can effectively control your income level by choosing how much to pull from your TFSA, and by controlling your income level, you control whether the government claws back your OAS or not. This is the most underused strategy in Canadian retirement planning, and it is sitting right there in your account right now. If this is making sense, and I hope it is because your financial future depends on understanding these moves, take a moment to like this video. Algorithms still matter, and your support helps us keep making this content free for people who need it most. The next piece of the puzzle is what I call the RRSP meltdown, and I want you to pay very close attention because this is where people make their most expensive mistake. The mistake is simple. They wait. They think they have time. They think they will deal with their RRSP when they are older, and meanwhile, the government is charging them an invisible debt that grows bigger every single year. Here is how the invisible debt works. Every year you leave money sitting in your RRSP, you are not just leaving it there. You are leaving the taxes undeferred, and those undeferred taxes are accumulating interest against you. The government did not give you a free pass on those taxes. They gave you a deferral, which means you still owe the money, and the longer you wait, the more complicated the situation becomes. Let me give you a real example that I see all the time. Imagine someone who is 65 years old with $300,000 in their RRSP. Their marginal tax rate is about 30%, which means roughly $90,000 of that $300,000 already belongs to the government. If they do nothing, that $90,000 debt sits there compounding, and by the time they are 71, the required minimum withdrawals from their RRIF will force them to take out so much money that they will likely land in a higher tax step anyway. So they end up paying more taxes than if they had acted earlier. The strategic move is to start converting that RRSP into a RRIF gradually, starting in your 60s, while you are still in a lower tax step. You take money out at a controlled pace, you pay the taxes now while the rate is manageable, and you get rid of that invisible debt before it turns into a real emergency. This is what I mean when I say the account collapsing. You are not losing your money. You are collapsing the tax liability into a manageable, predictable amount that you control rather than letting the government control it for you. The key principle here is something called the order of operations, and it is the most important thing I am going to teach you today. You have to understand that certain moves come before other moves, and if you do them out of order, you will waste money. The first move is always to get control of your RRSP because that is where the biggest tax bomb is ticking. Once that is done, the next move is to build your TFSA as a buffer account, because that buffer gives you flexibility in how you manage your cash flow in retirement. And once those two things are aligned, the third move is to look at your non-registered accounts and see if there are any assets you can reposition to further reduce your tax exposure in the future. I have a resource for you. If you go to the description box below this video, you will find a link to a free guide that walks through the exact order of operations step by step. But do not go looking for it until you finish watching this entire video, because what I am about to show you next might be the most important part of the whole strategy. If you are watching this and thinking about your own situation, I want you to do something right now. I want you to pause this video and go find your last RRSP statement. I want you to find your last RRIF statement. I want you to find your TFSA statement. I want you to physically write down the balance of every single account you have. Do not guess. Do not estimate. Pull the actual statements and write the numbers down on a piece of paper. This step sounds simple, and it is simple, but it is also the step that 90% of people never do, and without it, you cannot build a plan. Here is why the inventory matters so much. You cannot protect what you do not know about. If you do not know how much is sitting in your RRSP, you do not know how big the tax bomb is. If you do not know how much is sitting in your TFSA, you do not know how much flexibility you have. These numbers are the foundation of everything that comes next, and I cannot stress this enough. The people who come to me in crisis are almost always people who never did this exercise. They had the information sitting in a drawer somewhere, but they never put it together in one place and asked the hard question: how much of this money is actually mine after the government takes their piece? Now let us talk about something that affects almost every Canadian retiree, and that is the government takeback on OAS. The full OAS benefit is about $8,000 per year, and that sounds nice until the government starts clawing it back. The clawback kicks in when your income exceeds about $90,000 per year. And once it kicks in, every dollar of income above that threshold costs you 15 cents of your OAS. So if you have $20,000 of extra income above that threshold, you lose $3,000 of your benefit. If you have $50,000 of extra income above that threshold, you lose $7,500 of your benefit. The cruel irony is that the government forces you to take minimum withdrawals from your RRIF, and those minimum withdrawals can easily push you over the threshold that triggers the clawback. You are literally being forced by law to take an action that costs you money, and most people have no idea this is happening because nobody explains it to them. The protection against this is strategic drawing from your TFSA to manage your income level. You can also consider delaying your CPP or your OAS, which reduces your required minimum withdrawals from your RRIF, which keeps your income lower, which prevents the clawback. But these are advanced strategies that require a proper plan, and the plan requires the inventory I just told you to do. I need you to hear this clearly. If you are 65 years old and you have not done a comprehensive retirement income plan, you are playing with fire. Not because you will definitely get burned, but because the risk of getting burned is extremely high, and the damage when it happens is completely preventable. The government has set up a system where your RRSP turns into a mandatory income stream at 71, and that mandatory income stream can trigger a cascade of negative consequences, including the government takeback on OAS, pushed into a higher tax step, and a massive tax bill in the year of death if you have not elected the survivor benefit on your RRIF. If this feels overwhelming, that is okay. I am going to walk you through a battle plan at the end of this video that will break it all down into steps you can take this week. But first, I need you to understand the stakes, and I need you to understand that doing nothing is also a choice, and that choice has consequences. If you are finding this useful, please share this video with someone you know who is approaching retirement. The people who need this information most are often the people who think they do not need it, and a simple share could change their financial future. Now let us talk about something called the automatic vault transfer, because this is one of the most powerful tools available to married couples, and almost nobody uses it correctly. The automatic vault transfer is the official term for what happens when you designate your spouse as the successor holder of your RRIF. When you do this, the RRIF transfers directly to your spouse upon your death, completely outside of your estate. This means it does not go through probate, it does not get frozen by the courts, and it does not become part of the public record of your estate. But more importantly, it does not trigger a tax bomb in the year of your death. When a RRIF transfers through the automatic vault transfer, the surviving spouse simply takes over the account as if it were their own. They keep making required minimum withdrawals based on their age, not the age of the deceased spouse. This is critical because the required minimum withdrawal amounts are calculated based on age. And if you do not have the automatic vault transfer in place, the government forces a calculation based on the deceased spouse's age, which can be much higher and much more damaging. The paperwork for the automatic vault transfer is simple. It is a one-page form that you sign and send to your financial institution. But here is the problem. Most people never sign that form because nobody tells them it exists. Their bank manager does not volunteer this information because the bank manager gets paid to manage the account, not to protect the estate. So it falls on you to ask for it, and most people never ask. If you and your spouse have not discussed the automatic vault transfer, that conversation needs to happen today. Not next week, not next month, today. Because the difference between having this form signed and not having it signed can be a tax bill that is tens of thousands of dollars higher in the year of death. Let me be very clear about the stakes here. The average Canadian couple approaching retirement has roughly $300,000 in their combined RRSP and RRIF accounts. The government takes approximately 30% of that in taxes if nothing is done. That is $90,000. But it gets worse because the government take-back on OAS can cost another $5,000 to $7,000 every single year that you are alive. And if you have a spouse who survives you, that spouse may also face a similar clawback. So we are not just talking about a one-time tax hit. We are talking about an ongoing erosion of your retirement income that compounds year after year. The good news is that all of this is preventable. Every single problem I have described in this video has a known solution. The solutions are not complicated. They require paperwork and planning, but they are not complicated. What makes them difficult is that most people never learn about them, and the people who should be explaining them, like bank managers and basic accounting software, they do not have the training or the incentive to do so. So here's your battle plan. This is the sequence of actions you need to take this week, and I am going to give them to you in the order they need to happen, because order matters. The first move is to pull your statements. All of them. Your RRSP, your RRIF, your TFSA, your non-registered accounts. Write down the balances. Put them on one piece of paper. This is your starting point. The second move is to call your financial institution and ask about the automatic vault transfer form for your RRIF. If you are married or have a common law partner, you need this form signed and on file with your bank. It takes 20 minutes and it could save your spouse tens of thousands of dollars. The third move is to meet with a tax professional who specializes in retirement income planning. Do not go to your bank for this. Go to someone whose job is to protect your estate, not grow your account balance. Ask them specifically about the survivor benefit election for your RRIF and about a strategy called a RRSP melt, where you convert portions of your RRSP into a RRIF gradually over the next 5 to 10 years to manage your tax step. The fourth move is to look at your TFSA. How much room do you have? If you have room, consider moving non-registered assets into your TFSA to build that buffer I talked about earlier. The TFSA is your secret weapon against the government take-back on OAS. The fifth move is to create a written retirement income plan that shows exactly how much money you will draw from each account in each year of retirement. This plan should be designed to keep your income below the OAS clawback threshold for as long as possible, and it should account for the fact that your RRIF will force minimum withdrawals starting at age 71. I need you to understand something very clearly. Information without action is just a hobby. You can watch every video on this channel, you can read every article, you can have all the knowledge in the world, but if you do not do the paperwork, none of it matters. The government does not care how much you know. They care about what you signed. So here is my challenge to you. Today, before you do anything else, go find that first statement, pull it out, look at the number, let it sink in, and then ask yourself the question, what is that number worth after the government takes their piece? If the answer surprises you, that is exactly why you are here, and that is exactly why you need to act. If you found value in this video, please subscribe and hit the bell notification so you do not miss our next video, where I am going to walk you through exactly how to calculate your OAS clawback threshold and build a TFSA strategy that protects your monthly benefit for life. That video is the natural follow-up to everything we covered here, and together, these two strategies form the foundation of a complete retirement income plan that can save you tens of thousands of dollars over the course of your retirement. The battle does not end here. It starts here. And the first step is yours to take.